It is February 27th, 2026, and the Shanghai Futures Exchange silver vaults have just recorded one of the most dramatic inventory collapses in over a decade. According to data published by CEIC and tracked from the Shanghai Futures Exchange directly, silver stocks at the exchange have fallen from roughly 649 tons in early February down to 423 tons by February 4th. That is a drawdown of approximately 226 tons in less than 2 weeks. Let me say that again so it sinks in. 226 tons of physical silver drained out of those warehouses in under 14 days. And to understand just how extreme that is, you need one reference point. The long-run daily average for SHFE silver warehouse stock, going all the way back to 2012 when the exchange introduced silver futures, is 1,138 tons. Right now, the vaults hold barely 37% of what they historically hold on any given day. The COMEX letter, one of the most widely followed institutional market accounts in the world, with 276,000 views on this single post alone, flagged this on February 9th, calling the situation a collapse, and noting that available silver for delivery in Shanghai had dropped to the lowest level since 2015. And that is not even the most alarming part of this story. Here is the contradiction that should genuinely stop you in your tracks. On January 29th, silver hit an intraday all-time high of $121.67 per ounce on COMEX. That was a price nobody alive had ever seen silver reach before. And then, over the following days, it crashed back through the 70s, shedding more than 40% from its peak. The mainstream financial press, including comments from U.S. Treasury Secretary Scott Bessent, attributed that collapse to Chinese speculators getting blown out of over-leveraged positions. But here's the thing. While the paper price was being destroyed, the physical vaults kept draining. That contradiction, a falling paper price alongside accelerating physical withdrawal, is the central story of what is happening in silver right now. And it is the story almost nobody in mainstream financial media has connected end to end. If you hold physical silver, silver ETFs, or silver mining shares, and you are trying to make sense of what just happened and what is coming next, this is exactly the video you need to watch through to the finish, because by the end, you will understand precisely what JPMorgan has actually been doing with physical silver, why China reclassified silver as a strategic resource on January 1st of this year, what is happening at COMEX on this exact date of February 27th, which is first notice day for March futures, and where credible institutional forecasts are putting the silver price through the rest of 2026. Welcome back to the channel for anyone who has been here before, and for anyone new, this channel focuses specifically on verified exchange-level data and what institutional players are actually doing rather than what they are saying publicly. Hit subscribe and the notification bell, because what is happening in silver right now is moving quickly. Now, let us build the full picture from the ground up, because you cannot understand today without understanding the architecture of the silver market itself, and most casual observers have only ever seen one layer of it. The silver market operates on two completely separate tracks that, under normal conditions, stay close enough together that most people never notice the difference. The first track is the paper market, which is dominated by COMEX in New York and the London Bullion Market Association. On COMEX, roughly 500 million ounces of silver change hands on a typical day through futures contracts. The overwhelming majority of those contracts are never intended to result in the actual delivery of physical metal. Traders buy and sell them to speculate on price direction, and when the contract expires, they either roll it forward into the next month or settle the difference in cash. That is, the system that sets the global price of silver that you see quoted on every financial website in the world. The second track is the physical market, where actual silver bars, coins, and granules are bought, refined, fabricated, and consumed by industry. Solar panel manufacturers need silver paste. Electronics producers need silver for circuit boards. EV batteries need silver. The medical equipment industry needs silver. And investment buyers who want to hold a real bar in a vault need silver. These two markets are supposed to stay tightly linked. When they diverge, it means something structural is breaking. The divergence this year has been unlike anything recorded in modern commodity market history. According to analysis published by Pareto Investor in late December 2025, on January 1st of this year, while COMEX silver futures were showing $72 per ounce, physical bullion dealers in Japan and the UAE were selling silver, when they could find any inventory at all, at $130 per ounce. That is an 80% premium of physical silver over the official paper price. To understand how extraordinary that is, consider that gold, the most liquid and deeply traded precious metal in the world, occasionally sees physical premiums of 5 to 10% during supply crunches. An 80% systematic gap across an entire region is not a local anomaly. That is a signal that the paper price has become disconnected from what real metal actually costs in the real world. In Shanghai through late December, physical silver was trading at $8 above COMEX prices. In India, buyers were offering $5 premiums to secure metal. Queues formed outside bullion dealers across China, Japan, and Taiwan as physical inventory simply vanished from retail markets. Let that sink in for a moment. The official price said one thing. The actual market where you could buy real metal said something completely different. And that gap tells you everything you need to know about the stress fractures developing inside the paper pricing system. Now let us look at the COMEX data, because it is where the most precise numbers are available. COMEX registered silver inventory is the category that matters most. Registered means metal that has been certified, is sitting in an approved COMEX warehouse, and is actually available for delivery against a futures contract. This is the metal that stands behind all those hundreds of millions of ounces trading on paper every day. According to Disruption Banking, citing COMEX warehouse data, registered inventories have plunged from roughly 346 million ounces back in 2020 down to approximately 88 million ounces recently, which, as of February 2026, represents an all-time low. That is a 75% collapse in the actual physical backing of the paper silver market over 5 years. Think about what that means in practice. You have a futures market where open interest on the March 2026 contract alone represents approximately 500 million ounces of silver, and the total registered inventory available for delivery is around 88 million ounces. That means for every single ounce of real silver sitting in a COMEX vault ready for delivery, there are roughly 5 paper claims on that same ounce, 5 to 1. And that ratio has been getting worse, not better. The delivery data from December 2025 and January 2026 shows just how much stress that created. Felix and friends at Goat Academy, whose analysis has been widely circulated in the precious metals community, noted that in December alone, 47 million ounces of silver were claimed for physical delivery in just 4 trading days. That figure represents approximately 60% of the entire COMEX silver inventory being demanded as real metal in 4 days. And in the first 5 days of February this year, according to analysis from investing.com, nearly 19 million ounces were requested for delivery. Traders who held later-dated contracts began rolling them backward into the February contract, specifically because they wanted to take possession of physical metal as early as possible rather than waiting. That is not the behavior of speculators. That is the behavior of people who have looked at the inventory numbers and decided they do not trust that the metal will be there if they wait. This brings us to JPMorgan, and this is the part of the story that changes the entire narrative you may have been told about this bank and silver. For years, JPMorgan was the dominant short seller in the COMEX silver futures market. A short position means you are betting that prices will fall, and JPMorgan held massive short positions that, according to multiple investigations and a Department of Justice case that resulted in guilty pleas from their traders in 2020, were used to manipulate the silver price lower through a practice called spoofing. Now look at what CME Group delivery reports for January 2026 show. According to analysis from Pareto Investor citing the CME Group's own daily delivery notices, JPMorgan flipped from its short positioning and aggressively stood for maximum physical delivery in January 2026. The analysis describes it as a complete reversal, from short and hope for lower to take it all in physical. Over 1,000 contracts on a single day and thousands more across the month went to actual physical delivery, with JPMorgan as the buyer taking ownership of real silver bars. Citigroup and Deutsche Bank also appear prominently in those delivery notices. This is not small positioning. This is the largest bank in the United States quietly accumulating real physical silver at the same time the paper price was being hammered lower. Investing.com noted specifically that JPMorgan closed out its short position on the exact day silver collapsed into the mid-$70 range. They covered short, pocketed the difference on the way down, and then immediately pivoted to taking physical delivery on the other side. Whether you call that masterful trading or something more troubling, the timing is precise, and it is documented in exchange records. Pay close attention to this next section because it explains the mechanism that connects everything together. When silver prices were being pushed lower during U.S. trading hours in late January, analysis of the price action showed that the largest sell orders consistently arrived during New York trading sessions. The moves that drove silver from its $121 high down through 90, through 80, through 70 occurred predominantly when U.S. markets were open and U.S.-based futures traders were active. Meanwhile, the physical withdrawal data from both COMEX and the Shanghai Futures Exchange shows that during the same period, Physical metal was being taken out of vaults at an accelerating pace. One side of the market was selling paper, the other side was taking physical metal. This is not coincidence. This is a structural divergence between who controls the price-setting mechanism and who controls the actual metal. TD Securities, it should be noted, was caught on the wrong side of this trade. According to investing.com, TD Securities triggered a massive stop-loss position by betting against the direction of the market at precisely the wrong moment, which contributed to some of the volatility in the late January price action. Now let us talk about the China factor, because it is impossible to understand the 2026 silver market without it. On January 1st, 2026, China implemented new precious metals export controls that reclassified silver from an ordinary industrial commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver over the 2026 to 2027 period. Those 44 companies collectively control the export of approximately 121 million ounces of silver annually, which represents somewhere between 60 and 70% of refined silver traded globally. Let that number sit for a moment. China has placed government gatekeepers in front of roughly 2/3 of the world's refined silver export flow. That decision did not happen in a vacuum. China is simultaneously the world's largest industrial consumer of silver, the world's second largest silver producer, and now the government most aggressively positioning itself to control the future supply of a metal that its own solar and technology manufacturing industries depend on. The Silver Institute's data shows that China accounts for a dominant share of global silver industrial fabrication demand every single year. Implementing strategic export controls while your domestic vaults are draining tells you something very specific about what Chinese planners believe is coming. This is where the historical parallel becomes important. In 1979 and 1980, the Hunt brothers of Texas, Bunker and Herbert Hunt, accumulated somewhere between 100 million and 200 million ounces of physical silver in an attempt to corner the market. Silver ran from around $6 per ounce in early 1979 to an intraday high of $50.35 on January 21, 1980. The Commodity Exchange, the predecessor to COMEX, responded by implementing what was called Silver Rule 7, which effectively banned new long positions and turned the exchange into a sellers-only market. The price collapsed. The Hunts were ruined. But here is what is different in 2026. In 1979, you had two private individuals trying to corner a market through paper futures contracts. What you have today is the world's second largest economy implementing a national policy to secure physical silver supplies, while the paper pricing system is simultaneously showing inventory stress at the exchange level that no single billionaire family has ever been able to manufacture. The scale and the structural legitimacy are completely different. This is state-level accumulation, not speculative excess. Stop for a second. Think about what has just been laid out. COMEX registered inventories are at all-time lows. Shanghai vaults have shed 226 tons in 2 weeks and now hold just 37% of their historical average. China has put government licenses on 2/3 of global refined silver exports. JPMorgan, which spent years suppressing the silver price through documented short selling, is now taking maximum physical delivery. Physical premiums over paper prices reached 80% in Asia in early January. And today, February 27th, is first notice day for the March COMEX futures contract, meaning the first wave of traders who hold March contracts are now required to declare whether they want physical delivery or a cash rollover. The market is watching this date extremely closely because if even 20% of March open interest stands for physical delivery, the math suggests COMEX registered inventories cannot cover it. As one widely shared post from Wall Street Bulls put it in early February, with registered silver at around 110 million ounces and March open interest at around 500 million ounces, there are 5 paper claims for every physical bar in the registered category. That is not a small discrepancy. That is a structural imbalance. Let us now look at where professional institutional forecasters are putting silver prices for the remainder of 2026. Because the range is extraordinary, and the reasoning behind each forecast tells you something different. Citigroup has said silver could reach $100 per ounce by March, and potentially $110 by the second half of 2026, based specifically on the acute shortage of physical silver. JPMorgan's own global research team, according to their February 2026 outlook published on their website, sees silver averaging $81 per ounce for the full year 2026, which they describe as more than double the 2025 average. BNP Paribas also sees $100 as achievable by year-end. A Reuters analyst poll puts the median 2026 silver forecast at around $79.50 per ounce. Macro strategist David Hunter has publicly stated a silver target of $180. Rashad Hajiev, whose analysis focuses on the gold to silver ratio, argues that if the ratio continues compressing toward its 2011 low of 30, $250 per ounce becomes a mathematical expectation if gold reaches 7,500. The gold to silver ratio currently sits around 57 to 59, its lowest level since 2011. For context, the ratio was above 100 at the peak of the COVID crash in 2020. It has been compressing steadily as physical silver demand outpaces physical gold demand in industrial applications. On the cautious side, JPMorgan's own analysts simultaneously warn that silver remains vulnerable to corrective pressures if the prior price surge was driven more by speculation than genuine industrial demand. The Silver Institute expects global silver industrial fabrication to actually decline by about 2% in 2026 to a 4-year low, partly because solar manufacturers are beginning to use less silver paste per panel in a process called thrifting. Bank of America's target of $65 has already been surpassed multiple times this year. The honest assessment is that the range of credible forecasts has never been wider, and that itself tells you something about how uncertain and unprecedented this market has become. Now let us talk directly to you, depending on where you currently sit. There are essentially 3 different positions people watching this video are in right now, and each one calls for a different response. The first group is frightened. You watched silver hit $121.67. You either bought near the top, or you watched a position that was significantly in profit get cut in half in a matter of days. And now you are wondering whether the whole silver thesis has broken down, and whether you should sell everything to recover what you can. Here's what you need to understand. The fundamental supply picture that drove silver to its all-time high has not changed. COMEX vaults are still at all-time lows. SHFE vaults are still draining. China's export controls are still in place. JPMorgan is still taking physical delivery. A 40% price correction after a 130% run is painful, but it is not unusual in commodities. The silver market made a 50% correction in 2011 after its run toward $50, and then went on to establish what at that time were multi-year equilibrium levels. Selling into the low after the correction means you lock in the loss from the overshoot without participating in what most institutional analysts believe is the next leg. That does not mean you cannot adjust position size if you are overexposed and losing sleep. But selling because the price fell sharply after an extraordinary run is a decision made on emotion rather than the underlying supply fundamentals. The second group is confused and paralyzed. You understand that something important is happening in silver, but the scale and speed of price moves have made you feel like you cannot get your footing. You do not know whether to buy the dip, hold what you have, or wait for more clarity. The most useful thing you can do from that position is go back to the primary source data. Look at CEIC and check the SHFE warehouse figures yourself. Go to the CME Group website and find the daily delivery notices to verify the JPMorgan delivery activity. Read JPMorgan's own February 2026 silver outlook, which is publicly available on their website. When you verify the data yourself, instead of relying entirely on any single commentator, you move from confusion to a grounded position where you can make a decision based on what you actually know rather than what you have been told. The fundamentals in this market are transparent. The exchange data is public. You have the tools to check everything that has been described in this video. The third group already understands what is happening and sees the current situation as an opportunity. If you are in this group, you are likely already thinking about the March 1st notice day data that will become available over the coming days and how much physical delivery demand comes through against current registered inventory. You are watching whether SHFE vaults continue draining or stabilize after the Chinese New Year period ends. You are tracking whether Citigroup's $100 by March forecast proves accurate. The key variable to monitor is the physical to paper ratio at COMEX. If delivery demands continue at the pace seen in December and the first week of February, the registered inventory cannot sustain it without either a significant price adjustment upward to discourage deliveries or a shift to cash settlement that would fundamentally alter how the world prices silver. Either outcome changes the picture dramatically. The bigger structural story, beyond any single price move, is this. The way silver gets priced is changing. For decades, the COMEX futures price has been the global reference price for silver. Every mine that sells silver, every industrial buyer that purchases silver, every retail investor buying a coin or a bar references a price that is set primarily by paper contracts in New York and London. But as physical inventories drain from those exchanges, and as physical premiums in Asia diverge from paper prices, the center of gravity for price discovery is gradually shifting. Analyses from Trading Key and others published in January 2026 make the argument explicitly that if COMEX and LBMA continue defaulting to cash settlement rather than delivering physical metal, markets where physical demand is stronger, like Shanghai, Hong Kong, and other Asian trading hubs, will gradually take over as the genuine price-setting mechanism for physical silver. That is a slow process, and it is not guaranteed. But the directional trend of physical inventory flowing from west to east, from COMEX and LBMA toward Asia, has been observable and consistent throughout 2025 and continues in early 2026. The Kobeissi letter specifically noted that heavy silver exports from China to London in 2025 had alleviated the global physical squeeze somewhat, but depleted local Chinese stocks even further, which is why SHFE inventories are now at their lowest point since 2015. There is also an industrial demand story that is not going away, regardless of what happens to investment and speculative demand. JPMorgan's Greg Shearer, in a publicly available interview on the bank's research platform, notes that industrial demand represents approximately 60% of silver's total end-use consumption, and that this component moves far more slowly than investment demand. Solar energy manufacturing, electric vehicle production, AI infrastructure, defense electronics, and medical applications are structural, long-term demand drivers. The U.S. government designated silver as a critical mineral with national security implications. That designation did not get reversed, and it points to the same conclusion that China reached when it implemented export controls, which is that silver's role in the energy transition and in advanced electronics makes it strategically important in a way it simply was not 20 years ago. The question of whether solar manufacturers will successfully thrift silver out of their panels is real and worth watching, but it is a multi-year transition that is unlikely to meaningfully offset the acceleration in overall unit demand from the sheer volume of panels being installed globally. Where does this leave the price over the next 2 quarters? The honest answer is that credible forecasters are split between outcomes that are miles apart. The conservative consensus from institutions like ING, Saxo Bank, and Bank of America clusters around $55 to $70 per ounce as a 2026 average. JPMorgan's call for an $81 average puts the floor considerably higher. Citigroup's 100 by March call is aggressive, but not without a mechanism, given that today is first notice day, and the delivery data over the next 2 weeks will test that thesis directly. The bull case that takes silver back toward its $121 high and potentially beyond rests on a specific sequence, which is that COMEX delivery demand exceeds registered inventory capacity, cash settlement becomes visible and widespread, Asian exchanges step up as alternative pricing venues, and institutional investors who currently only hold paper silver ETFs decide to shift toward physical, adding another wave of delivery demand to the system. That sequence is possible. It is not inevitable. What is clearly true from the data is that the physical market is tighter than at any point since the exchange data begins in 2012, and that the gap between paper and physical silver has been wider in the past 2 months than it has ever been in recorded history. The single most important number to watch over the next 14 days is not the COMEX paper price. It is the registered inventory figure, which is updated daily by CME Group and is publicly available on their website. If registered inventory continues falling, while open interest on March contracts remains elevated, the pressure on the paper pricing system intensifies. If inventory stabilizes, or if a significant portion of March contracts roll forward rather than standing for delivery, it suggests the immediate squeeze is easing. Both outcomes are possible, and both tell you something real about the balance of power between the paper market and the physical market right now. What happened on January 29th, when silver hit $121.67, may look like a blow off top. It may also look, in 6 months' time, like the moment the world began to realize that the paper pricing system for silver could no longer reliably represent the cost of obtaining real physical metal. The vault data from Shanghai suggests the physical market has made its position very clear. 226 tons of silver left those vaults in 2 weeks. That silver did not disappear. It went somewhere. And it went there because whoever took it valued the metal more than the current paper price implied it was worth. That is the real story of silver in February 2026. The price tells you one thing, the vaults tell you another, and historically in commodity markets, the vaults are always right in the end. If you found this breakdown useful, subscribe to the channel and leave a comment below telling us one thing. Do you believe the COMEX registered inventory can survive the March delivery period without a significant disruption? Or do you think we will see cash settlement become visible for the first time? That debate is happening right now at the highest levels of commodity finance, and your view on it will shape whether you see this as a buying opportunity, a reason to hold, or a reason to wait. The data is in front of you. The sources are public. Make your own call.